Hi, good afternoon, and thanks for joining us as we deliver the Beacon Trust Mid-Year Outlook. My name is Brian McGann, and I'm the Head of Investment Strategy here at Beacon Trust. Today, I'm joined by my colleagues, Dr. John Longo, our Chief Investment Officer, and Susan Hayes, our Head of Fixed Income. For the next 15 to 20 minutes, John's going to be going through some key economic data, our equity market outlook, and some issues that are giving us a little bit of concern. Susan's going to touch on our fixed income outlook and also comment on the all-important Federal Reserve Open Market Committee meeting being held next week. I'll then wrap it up with some portfolio implications and some highlights from the first half. We'll address any questions that either were submitted prior to this webinar or during the webinar at the end of the presentation. But before I turn it over to John, I'm just going to cover the logistics of the webinar. Each caller is on listen-only mode. Should any questions arise during the presentation, please feel free to email them to support@beacontrust.com, or if you're logged into the webinar, you can enter them into the questions section in the right-hand corner. Today's slides were sent out via email to all who registered, but if you're logged into the webinar, you can see them on your screen or download them from the handout section, also on the right-hand corner. We're recording today's call, and we'll post it along with all of our other published content to the Insights section on the Beacon Trust website. So without any further ado, I'm going to hand the presentation over to John Longo.
Thank you, Brian, and thank you everybody for joining us. I think it's a great time to have this call because yesterday the S&P hit an all-time high, despite being down a little bit today. I think it would help to give some perspective on what has happened to the market over the past year. So if you're looking at the screen, we have a one-year chart in the S&P. And of course, you probably know we had a very strong correction in December. The low is actually Christmas Eve, and the market was down around 18 to 20%, depending upon how you count it. So even though this year we're up roughly 20%, overall, year over year, we're probably up 4 or 5%. So one point we want to make in this call is that we don't have a great focus on calendar year returns. We like to look at rolling period returns. In terms of what we think spurred the year-to-date strong performance, I think it happened because of at least 3 factors. Perhaps the most important is the Fed moving from a hawkish tone to dovish. To expand on that, at the end of last year, the Fed was forecasting a 325 basis point rise in interest rates, so 0.75%. Fast forward to today, and my colleague Susan will elaborate, they're very likely going to cut rates at least once this year. So that's probably the most important thing. The second, which seems like a long time ago, was the end of the longest federal government shutdown in history. Why that's important is that it hurt consumer confidence, and we know that the consumer is about 70% of the U.S. economy. Fortunately, consumer confidence has bounced back fairly strongly. The third reason, which is fully not resolved yet, were the trade tensions with China. They intensified near Q4 of last year and have been moving in the right direction, even though, as I said, they're not finalized. So that's where we've been, let's call it 20%, but of course, we're here on this call to talk about our outlook. And our outlook is still positive, but clearly, we're not expecting another 20% return in the second half of the year. Some of the things that we like to do are look at forward-looking indicators, and one of my favorite is called LEI, which stands for Leading Economic Indicators. And it's a basket of 10 different indicators, things like credit spreads, the unemployment rate, even stock prices. Now, if you're looking at the screen, it might be a little bit hard to see, but the gray area, the gray shaded area, indicates when we're in a recession. And what you'll notice is that LEI has a pretty good track record of going down in advance of every recession. And looking to where we are today, especially the past 12 months, we see continued growth, although it is leveling off. So this is kind of a microcosm of what we think for the economy, continued slow growth. In that environment, we think both equities and fixed income can deliver positive returns, but not outrageous or double-digit returns, at least going forward from here. Another forward-looking indicator is a survey of buyers or purchasing managers. These buyers and purchasing managers have a window into their business. And the group that conducts these surveys, at least the most well-known, is called the Institute for Supply Chain Management. They do a manufacturing survey, which I have on this slide, and a services survey, which I'll have on the next slide. So manufacturing, of course, includes things like autos, defense, energy, and so forth. And how you interpret the number is that if the reading is greater than 50, it signifies expansion. Something less than 50 would signify potential contraction. If we have perhaps two monthly readings below 50, that might raise a flag that a recession is more likely than not. And if you're looking at the screen, you can see the numbers are still positive, over 50, but they are declining. So this is consistent with our view of perhaps a 2% GDP, despite the 3% or so we had last year and Q1 of this year. So that was a manufacturing survey. Here is the services survey, a similar picture. Services, of course, would include things like financial services, healthcare, education, and so forth. We see slightly stronger numbers, but the same pattern of decelerating growth. So to repeat, we're seeing modest growth, let's call it 2%, and not very strong growth. And that will have implications for earnings, as I'll address in a moment. Yet another indicator for potential recession is a so-called credit crunch. Fortunately, the Fed tracks bank lending. It's a little bit of a lag, usually about a 1 month lag, but what you can see here is that lending is up year over year. In recent months, it's leveled off, but it is not contracting like it did during the Great Recession. So no credit crunch, although it might be harder for the marginal buyer or borrower to get credit at this point. So to summarize our view in the economy, we think it's in pretty good shape. If you look at most of the indicators, for example, unemployment, it's near a 50-year low. We think GDP will be positive, but kind of decelerating to call it, let's 2-ish%. And most of our leading indicators suggest continued, albeit slower growth. Let's move on to the stock market. I mentioned the tremendous performance year to date. This chart, of course, is from June 30th. And sometimes it helps to understand if the market is expensive or cheap, at least relative to prior history. This main part of the graph is the price to earnings ratio, or PE. It's the most common valuation metric. It's been in the stock tables of the Wall Street Journal since at least the 1950s. So if you're looking at the screen, you can see a forward PE, price divided by consensus earnings for the next year, of around 16.17. That is slightly above the 25-year average. So that suggests that perhaps stocks are fairly valued, but they're not outrageously overvalued as they were during the internet bubble, which you can see in the left part of the screen, nor are they a screaming buy if you had the courage to invest in March of 2009. So we think the market can support this multiple, especially in a backdrop of modest interest rates, potentially declining interest rates, modest inflation, and relatively low taxes versus the long-term history. Not only that, the market, of course, is made up of stocks. So this picture is called a thermographic or a heat map, and green means the stock is cheap on that PE basis, and red means it's expensive. Now, just because a stock is red, it doesn't mean we wouldn't own it. In fact, these are some of our best performers. They're growth stocks. So you can look at Microsoft, which has now taken the torch and is the most valuable company in the world currently. So the point is, the market is made up of stocks, and Brian will touch upon the success of some of our strategies later. We continually comb the universe and try to find pockets of value in both universes, the value and growth sectors. Now, we're thrilled with the 20% plus year-to-date performance, but we want to also give our clients a reminder, or dare we say a reality check, and that the volatility has been fairly benign. You can see, I know there's a lot going on the screen, but every single year there's a drawdown. On average, that drawdown averages roughly 14%. And this year, we've been somewhat spoiled with a maximum drawdown of 7%. Of course, I touched upon the severe drawdown last year, but going back 2 years, the drawdown was an incredibly low, only 3%, which ties the record we had in 1995. So bottom line, it is par for the course to have volatility, on average 13.9%. We would love the market to sail through the rest of the year, but we don't think it's likely. So buckle up for some volatility, but that's why we have a diversified portfolio and have had some great performance year to date. You can take some of that money from the bank, so to speak, and use that to withstand the drawdown. Now, if there's a bullish chart, the most bullish chart in our presentation is probably this. Now, there's a lot going on here, but what's happening in this picture, it shows economic expansions over the past century. And one theme, if you want to be bullish, is lower for longer. So on the bottom part of the screen, what you'll notice, the bottom kind of jagged line, that's the current expansion we're in since March of 2009 or early 2009. And it's the longest expansion. We've just set the record, at least since the U.S. has maintained data, but it's also been one of the most sluggish on record. So over a 10-year period, we've recovered only about 25%. Using simple arithmetic average, that's about 2.5% per year. If you use the more appropriate geometric average, it's roughly 2% per year. So the point is, just because we're in a long-term expansion, it doesn't mean it inevitably has to end. We like to look for a causal reason, whether that's a recession or a drop in lending or drop in earnings or some other type of risk that we'll talk about. So we like to look at history as well as other examples, not that we're Australia or China, but both of those countries have gone 20 years without an official recession. So we hope it keeps going on, but we're also cognizant of the history. The lower for longer could be a reason for optimism. So if we were to summarize our view on the stock market, we're kind of thankful for the 20% return year to date. Looking forward, we still think we can deliver positive returns, mainly because of the lack of attractive alternatives, the likelihood of a cut in interest rates that Susan will elaborate on, and the valuations are reasonable. They're not crazy expensive. Not to mention, we're still excited about a number of the firms that we own in our portfolios. We are not super bullish because I mentioned the accelerating economic growth. The trade war is not officially over. And it is the longest bull market and longest economic expansion in history. So we do know the odds are it is nearing an end, not an imminent end, but more towards the end than the middle. So another thing we like to look at is inflation. Now, inflation, the Fed has as a goal, really two goals. One is to have low unemployment, and it is probably near the lower end of that goal. Post-World War II, about 3.5% has been kind of a bottom on unemployment, and we're currently around the 3.7 or 3.8 range. Their other goal is to have stable prices. And in recent years, they've actually put a target on that. They want to have inflation at about 2%. And if you're looking at the chart, for the past 6 months or so, the inflation readings have been below that. So we believe that the Fed will be on hold for a while, if not cutting rates, and this tame inflation environment is a positive for both the stock and the bond market. So there are always risks in the market. Here are some of the things that we're concerned about. We are still concerned about the risk of the trade war, not only with China, but the Trump administration is also setting their sights on Europe and some of our other trading partners. Obviously, a trade war, at least from a profit perspective, tends to be bad for all parties. It reduces profits. In many cases, it raises the price for all of us consumers. So it seems to be moving in the right direction, but clearly it's still a risk. The U.S. federal budget deficit hit in excess of $1 trillion. That is a risk. Obviously, it could result in less spending in the future, higher interest rates, and potentially a cut in entitlement programs that I don't think anybody wants. Another simple risk is a shift in investor sentiment. It's been fairly ebullient as of late, but that can change very quickly. So people can say, today I'm willing to pay 16.7 times earnings for stocks. Tomorrow they might say I'm willing to pay 15 or maybe even as low as 12 times earnings. There are some signs of recession in Europe. Many countries in Europe, especially Germany, are export-oriented, and they're having a hard time with a lot of the slowdown around the world, notably in China. There are risks in the Middle East, risks in Venezuela, which is a large oil producer, and North Korea. I just read in the news today they've tested some missiles, fortunately not nuclear missiles, but that relationship is not fully, I guess, on a path to peace. Let's hope it gets that way, but it's a long time in coming. So now I'm going to hand it to my colleague, Susan, who will elaborate on our thoughts on the fixed income market as well as the Fed meeting next week.
Thanks, John. So we're halfway through the year, and I think it's safe to say that the path of interest rates has moved in a very different direction than what the market was expecting at the end of last year. If you remember, we were bracing for higher interest rates and Fed hikes. So now at this point, we're actually on the verge of the first Fed rate cut since 2008. So with that backdrop, I'd like to take a couple of minutes just to recap the second quarter and what happened throughout the quarter. So as John mentioned earlier, the expectations for Federal Reserve intervention in the form of a rate cut grew over the course of the quarter due to trade concerns, low inflation, and the Fed's well-telegraphed desire to keep the economic momentum going for as long as possible. So at the beginning of the quarter, the data was fairly weak, and the drumbeat for a 50 basis point cut actually grew louder over the first part of the quarter. If you remember, the May jobs number missed by quite a large amount, and also you had some weak manufacturing data. So all of that led the market to expect a bigger cut in the form of a 50 basis point cut at the beginning of the quarter. As the data flowed in throughout the quarter and the June numbers came in, they were actually a little bit better. So the market changed sentiments a little bit and now is looking for a 25 basis point cut at the next Federal Reserve meeting, which is next Wednesday, July 31st. We do think that the Federal Reserve will make a 25 basis point cut next week, a so-called insurance cut. So although the labor market is still strong and John outlined low inflationary conditions, there are a growing list of global uncertainties that John also outlined in his previous slides that we think the Fed will act. We think they have enough cover to do this insurance cut and to cut 25 basis points. So if they do that, the new Fed funds rate would be 2 to 2.25 instead of 2.25 to 2.5. We do anticipate one more 25 basis point cut later on in the year. So as far as overall yields for the rest of the year and our outlook for the bond market as a whole, we expect the 10-year Treasury market to still trade in a range of 2 to 3% for the rest of the year, generally trading towards the lower end of the bound. Right now, we're around a 2.08%. We've been towards that lower end of the bound for quite a while now, but we expect 10-year Treasuries to trade in that range for the rest of the year. The yield curve does remain inverted, and many of you know that we've been following this very closely. That's something that we're watching, as in the past it has been a signal of recession. We did write a piece on this, our thoughts on an inverted yield curve. If you'd like to reread that piece or you'd like to get a copy of it, please reach out to your representative at Beacon, and they'll certainly provide that for you. The performance this year in high-quality fixed income, which is a sector that we focus on, both for taxable and tax-exempt, has exceeded our expectations. So we will caution that the second half of the year, performance could be somewhat muted. I wouldn't expect the same kind of outsized fixed income returns for the rest of the year. We do think that credit quality on the municipal side is generally solid. For example, Moody's recently released a report saying that most U.S. states have the financial flexibility and reserves to manage a recession. On the taxable bond side, although the economy is slowing, earnings have generally been good for corporations, so this will support the credit quality on corporate bonds in the near term. And as always, we continue to own bonds to provide income and act as a portfolio diversifier, and we prefer in our portfolios to own high-quality, short to intermediate bonds. So with that, I'll turn it back to Brian to talk about any Q&A or follow up with any comments.
Okay. Thanks, Susan. Before we hit the Q&A, I just wanted to sort of summarize and wrap up the comments and then portfolio implications. So, as you can tell, we're cautiously optimistic for the rest of the year. There's a lot of risks out there that John highlighted that, we keep in mind all the time, but nothing out there has caused us to alter our outlook. I'll bring you back to the fourth quarter when things, in the financial markets, the equities especially, were really being driven by a lot of negative sentiment. However, the economic data that we looked at was still coming in relatively strong. Our advice to you then was to stay the course and do nothing. Do not alter the asset allocation, and try to ride through the volatility. And as we look back today, that seems kind of accurate, and it still remains accurate for today. So our advice really, and what we've done and counseled clients, is to really continue to be invested. Nothing on the horizon would right now in the short run cause us to alter our asset allocation recommendations to you. So again, let's stay the course. So finally, again, as you know, markets have been up. I just wanted to do a little highlight of some strategies. I realize we have a diverse group of clients on the line, and we have a diverse product offering and product lineup and an investment solution lineup here at Beacon Trust. So a couple of the highlights from the first half of the year: two important components to our open architecture risk control platform. The Beacon Plan Return Fund through June 30th was up about 12.7% versus its benchmark of 9.3, which is a U.S. funds option-based benchmark. The Accelerated Return Fund was up about 19.7, again, relative to that same benchmark. So great outperformance, and those are two key components to that open architecture risk control platform. On the more traditional investment side, the individual equity strategies, I'll highlight two of the flagships. The core equity strategy, June 30th, up 22.8% relative to the S&P at that time, up 18.5%. And then our income-focused income and appreciation strategy, up 17.3%. So compare that to the S&P of 18.5%, but the Russell 1000 with a little bit more of a value tilt, which that strategy carries, up 16.2%. And I'm happy today to be able to tell you that the four that I just highlighted have improved since the end of June with market performance. So again, I just wanted to highlight a couple of the successes for the firm and for our clients as we progress through the first part of the year and into the second part. So we had a few questions that came about prior to the webinar. So the first one I'll let John handle, and it was John, why don't you take that?
Yes, here's the question: how will dividend growth equities fare in the second half of the year with the Fed likely to cut rates? Well, we think a cut in rates would actually be a positive for dividend-oriented stocks. Of course, as rates fall, if you own a bond, it goes up. But if you're investing new capital, those bonds may look less attractive. So we think investors will look around and they'll find a home for some of that capital in dividend-oriented stocks. Within dividend stocks, there are two types: high dividend and dividend growth. We think both will do well in a low-rate environment.
Yeah, I think that goes to one of the other questions about growth versus value, or if growth's not going to work as it has for the past, through this whole economic expansion, what works from here? We actually think both can work, and I'm really encouraged by the fact that it looks like the market's broadening out a little bit away from the technology-led focus or the very narrow focus that we've seen. And everybody knows the FANG acronym and so forth. But the you can just see it in the performance of the two growth equity strategy versus the income focus, and they're both really right on top of each other, which to us is very healthy that the equity markets are broadening out. So we would agree with that comment that we do think in a low interest rate environment there's a lot of attractive opportunities. And if I can pull you back to that heat map that John was talking about, when you look at it again, you can see there's value in every sector. So we're finding value in technology, we're finding value in financials, and we're finding value in discretionary. So it's really broadening out, and that's very encouraging. There's a question that came in regarding during the webinar, comments on equity sectors for the next 6 months, so leading up until the end of the year. Again, I would just go back to my comment I just made about the broadening out of the sectors. We still find value across the board, and you know, that looks relatively good. With a low inflation, low interest rate environment, of course, we think the growth-oriented technology stocks where you don't need pricing power to make your revenue and earnings numbers will still continue to perform, but not just, you know, the more aggressive growth names. John had mentioned Microsoft before, still has a pretty reasonable valuation for the amount of growth that it's has potential to getting into the cloud environment and so forth. So names like that in technology seem to be working very, very well. Discretionary continues as the consumers remain very healthy and very optimistic. So again, the broadening of the market we think is very, very healthy. Susan, do you want to take or John, do you want to weigh in on the question about Congress, the budget that was just reached, and the level of debt?
Well, no doubt about it, increasing the deficit is not great. First of all, let's be clear, we're not in the camp of the whole so-called modern monetary theory that deficits don't matter. They do matter because at some point you eventually have to pay back the debt. Why the markets, I think, aren't kind of reacting dramatically to the continued increase in debt is that the carrying cost of debt tends to be low. What I mean by that is that interest rates are very low. So if I owe money or if I have a loan, it's the interest rate that I have to pay on that debt that winds up in the annual budget. So giving you some specific numbers, interest payments on the debt are about 8% of GDP. Now, it's not a small number, but it's not terribly worrisome. If somehow we were to go back to a more normalized interest rate environment, which might be the case in 3 to 5 years, well, in that case, the amount of the budget going to service the debt might be in the teens, and that would be very troublesome. If you play that out to the extreme, if there's no growth, well, at the end of the day, we might have to cut some entitlement programs, which I think that none of us would be happy with. So we're keeping an eye on it. As long as interest rates stay low, it's a concern, but not a great concern. As interest rates increase, I think Congress will be forced to have a more balanced budget.
Okay, I think one final question that came in regards gold, and is gold high? The answer that I can give to that is, gold's had a nice run here, a nice rebound. Gold generally in the past has been used as an inflation hedge or somewhere to go when there's some volatility, some global volatility. And of course, we've seen a number of different events over the past couple of weeks and months in the Middle East. North Korea, John had highlighted, we had an oil tanker from the UK be, hijacked. And so with that sort of turbulence, we've seen a little bit of a flight to gold. Earlier in the year in some of our strategies, we did increase our positioning, our weight in gold. So can it go higher? Yes. If there's turmoil out there, yes. But, is it too high? It's hard to put a valuation on gold at this point, but, we know why people generally tend to migrate to it. The interesting thing about the energy, the Middle East conflict, and especially the tanker, Venezuela problems that John alluded to prior, last year at this time, oil was about $69 a barrel. Today it's 55. And 10 years ago, if we would have seen events like this happen, oil would have been heading closer to $100 a barrel as opposed to 55. So supply is a big factor there, and now we're faced with a little bit of slowdown in the demand question. So it's an interesting turbulent time to be a commodity investor. But again, it could go higher with turbulence, but really we like it as a diversifier. and, as kind of a protection. No other questions have come in. So at this point, I'd always remind you that, any member of your Beacon team is always available for questions or comments regarding, your portfolio or financial plan, taxes, things of that nature. Everything that we try to provide to clients here, we're always open for the conversation. I'd like to thank everybody for taking the time out of your beautiful afternoon here to dial into the webinar. And I'd like to thank John and Susan for their comments. And we look forward to always our next portfolio review. Thanks very much.